Good morning and welcome to the April edition of the Balanced Perspective with me, your host, Mansoor Naka of Negative Investments. As usual, sharing his insight and wisdom is Iain Power, the CIO of Truffle Asset Management. Welcome, Iain.
Morning, Mansoor, and morning to everyone joining us on the call.
Iain, we've come to the end of the first quarter of 2024, and now I thought it would be a good time to sort of get a pulse of what's going on in the local investment landscape, given that we've had a flurry of earnings come out in Q1. And I think given the title of today's episode, the waiting game, patience has really been a virtue needed for holders of SA stocks. So probably now a good time to get insights into, how corporates have been faring in this environment. So to get straight into it, Iain, can you provide us with a brief summary of the market trends that you've been seeing in the first quarter?
Yeah. So I think, Mansoor, you're right. We've had, lots of earnings out from many of our local companies. And I suppose the trend that we've seen has been one of decent financial performance over the last, couple of months, at least the last half a year, six months, particularly with the low COVID base. So you're starting to see decent numbers come out because of the low base. But at the same time, I think many of the companies are also guiding a more cautious outlook given elections, given, sort of the low growth environment that we've got in SA, notwithstanding the increase in earnings that you've seen from a low base. So I think to sort of sum it up is that we are seeing some reasonable earnings numbers that probably a few percent shy of what people were looking for. So in other words, companies are growing, but they're growing slightly slower than perhaps what the market anticipated. And I think largely because of many of the big structural issues that we know the country is facing, and perhaps also a bit of a hiatus or people sort of sitting, waiting for, the 29th of May, which obviously election day for us, which is a big day, and, to sort of see how things pan out from there. And depending on that outcome, I think there are different scenarios that we are then looking at in terms of the economy, and then obviously from an underlying asset class performance. So I think that'll be the one big theme that we've seen. I think the other theme is one of, the global cycle being stronger for longer, led by a strong US economy, which remains resilient in the face of higher rates for many of the reasons which we've said over the past 12 months. And even though it's slowing, it's still relatively stronger than everything else. And then on top of that, we're starting to see green shoots of the global manufacturing cycle. With now China starting to find its feet in terms of manufacturing, and we're seeing that echoed through in the US, and Europe seems to be bottoming out. So I think from that perspective, that probably sets the tone for global markets which have been off to the races in the first 3 months of the year. I think the MSCI All World Index is up just under about 8% or 7.5%, and EM I think still lagging, because of the fact that you've still got rates which global rates which haven't been cut yet, and I think emerging markets sort of struggling under the weight of that at the moment.
Thanks, Iain. At the high level, coming back to sort of corporate SA, what are you and the team seeing from the various sectors and companies that have reported? Maybe, management teams that you've spoken to, any nuggets coming out of the results? How are companies coping?
So as I said, I think if we sort of break it down and we look at, for example, the financials, I think we sort of had reasonable earnings numbers coming out of all our financials. But I guess the message that we're seeing is that growth is perhaps going to be slightly slower than what was anticipated. So in other words, if I contextualize that, maybe, there was an expectation of 10, 12% earnings growth for next year. Maybe the number's going to be sort of closer to 8, 9%. So, I mean, the differences are not enormous, but you're seeing, generally across the board that I guess companies feeling the weight of an economy that is struggling to grow, and where local rates are still high, and where we're not able to cut rates because, US and DM has not started that cycle yet. So I think financials, very, very cheap, very high dividend yields, anywhere between 7 and 11%. Maybe the standout, I'd say, is like Investec, probably, much, much better numbers than everyone else, less credit loss ratio issues, and I guess getting the benefits of a business which has been refocused, repurposed, and is generating better returns for shareholders. And I think, they're probably one of the big reasons why you've seen an enormous outperformance on a relative basis from the likes of an Investec over some of the other banks. It's a position that we've had in the portfolio for quite some time. From the industrial perspective, I think, they're a mixed bag. Generally, I'd say softer results than, as I say, what was expected, probably softer than even the financials. So I think that's, and that really talks to the growth or the lack of growth in the economy. And then on the retail side, I think, there we'll probably see better results because of the load shedding base, but it's all going to be about the guidance for the next year. And, what can these businesses grow at? And I guess, do we see some of the economic reforms that we are expecting to accelerate post the elections? And I think that's going to set the scene for what potentially we can expect from some of these asset prices. I think the small and mid-cap space, also a mixed bag. I think in the construction sort of infrastructure space, those companies all coming out with pretty good numbers, full order books. There's lots of work with less contractors to execute. So I think those businesses are in a good space. And then I think if you sort of look across some of the food companies, perhaps a lot harder for those businesses, still struggling with the effects of, ShopRite, which continues to dominate in that space and take share and put, some of the weaker companies under pressure. And I think, so I think every sector's got its own nuances, but I'd say that the overall theme is one of caution into this year, everyone waiting to see what elections bring. And I think even though we've had some growth off the very, very low base, it's really going to be about what the businesses can do over the next 12 to 24 months in terms of earnings. And I think that's also going to be a function of, what the underlying economy is. But I'd say that the global companies which happen to be listed here, we've actually seen pretty good numbers from them. So I think, the businesses external to SA are getting the benefits of a world which has been growing. And remember, a big chunk of our market is actually offshore. And, investors are able to buy a lot of these decent quality businesses at low prices. So I think a sort of, a tale of two halves where SA and SA businesses are growing, but growing slower, and global businesses enjoying the benefits of wins behind their sales in terms of, global growth still being reasonably resilient and robust.
So sort of a really stock pickers market, having to separate sort of the good business from the not so good ones. Iain, we know that the local market has been depressed. You mentioned the challenges that we're facing. But in your view, is there anything that the market might be missing? Like as you mentioned, the banks coming out with decent results, but we haven't seen this material uplift in shares. So what do you see?
Yeah. So I think we sort of got to go back to the basics and really look at, the issues that are still holding back our valuations. The one is that, investors would have seen our long bond yields kick out. And I mean, we've got, I think, a 2035 sits just over 12%. Which, in itself is an attractive yield, but I think also talks to global investor concern around SA's fiscal position and sustainability over the long term. So I think that provides quite a high hurdle rate for some of the SA equities. So that's the first point. But that's not dissimilar to, for example, to a Brazil, where they've also got reasonably high rates. So I think, at the moment, money is not chasing low quality cyclical EM assets. It's waiting for global rates to be cut. So EM, for example, was a relative underperformer in the first quarter, and most of the action that we've seen has come from the big developed markets, Japan, Europe, and the US, whereas EM is still the big laggard. But as you correctly point out, that valuation gap between them is becoming absolutely enormous. And the moment that global rates look as though they're going to be cut and we start that cycle, you should see capital move from, let's call it the higher quality markets into higher yielding, lower quality assets. But on top of that, there's the SA idiosyncratic factors. The fact that we are struggling to grow in a global economy where, there is a lot more growth to be had in many other geographies. And I think, investors perhaps allocating on that basis. So I think until such time as there's clarity around elections and potentially some of the reforms coming through around the infrastructure, the Transnet recovery plan, Power's already looking much, much better. Until that drumbeat gets louder, I think you're going to have this value apparent sitting in many of our assets. But even if we look at SA, I think SA in dollar terms for the first quarter, probably down 4 or 5%. Brazil was down 8% in the first quarter in dollars. So, it's not like we are alone in terms of the cyclical EMs that are still under pressure. I think it's a question of patience and for many of these factors now to get behind us. And I think, to be fair, the big one is going to be elections, to get a sense of, what the elections hold for us and what the outcome is in terms of, ANC perhaps losing their majority, and can we establish some sort of sensible coalition. And I think, if that is the case, then all we need is for the rate cuts in the developed markets to start, which we think probably happens in June. And then I think it sets up an H2 or second half of this year, which could be, pretty interesting.
Indeed. But for now, we seem to be in a holding pattern. So indeed, it is going to be a waiting game. But hopefully, that patience will be rewarded. As we know, investing is a longer term sort of marathon and not a sprint. Iain, we'll leave it there for now. Again, as always, thank you for your time and your insights and your wisdom. Thanks for everyone for joining us. Thank you.
Thanks, Mansoor.